Hi, and welcome back to Pay Down Debt Solutions. I'm Jen, and I'm back today to talk to you guys a little bit more about what you don't know and how what you don't know can hurt you. So, I love my job. I love my job because I get the opportunity to teach people, and I have been a coach and a mentor and a teacher for many years, and I find it amazingly fun to do, right? So for me, coaching and teaching gives me great joy because I get to teach people about things that could impact or change their life. So that was something that I ran across to the other day when I went to the bank. And so, first of all, I do want to talk to you a little bit about what you don't know can be costing you money. And so, it's really relevant today because of the situation that I had running to the bank to go over an online banking issue that we had. Needed to see my business banker, and so I ended up bumping into a gentleman that was sitting in the lobby, and so he and I were waiting and we struck up a conversation. And that conversation, since were waiting for the same business banker, we kind of got started talking about businesses and running money and finances, and he ended up telling us that he was a startup business, that he just started a business, and how he had a loan, that he had taken out a loan for that, and it was just a personal loan, so it wasn't a business loan or business line, but he took out a personal loan. And then he asked us what we did. And so Dan and I looked at each other and we said, we offer people solutions. We offer them solutions for their debts and for their finances. And he kind of looked at us and he said, well, what does that look like? So, what do you do? So this is when we got into a conversation about traditional banking and how the traditional banking system works and how most often people end up in loans, and we actually teach lines of credit. So he was pretty taken aback by that. And he said, yeah, but a loan has so much less interest. And I said, they do. But at the end of the day, if you learn to run your finances just a little different, we can teach you something new. So he said, okay, I'm game. Show me what you're talking about. So I'm going to go over his situation with you guys in just a few minutes, but let's talk about what you don't know, okay? So when it comes to banking, what you don't know is costing you money. And in this gentleman's case, it was costing him money. So traditional banking solutions or tools may not be the problem, right? It might not be the tools that you're using or the tools that you're in, but it could be that the tool you are in is the problem, okay? So it could be the tool you are in is the problem, that could be, or it might just be how you're using that banking tool, right? So we all know that, to have a house these days, most people end up with mortgages because they aren't going to pay that out of their pocket, and the majority of people don't. So if they want a home that is their own, right, or that will be their own once they finish paying the bank, then they go and they get a mortgage, okay? And so that's a loan that in a lot of ways is unavoidable. You need a loan for that unless you use a different type of tool such as a first equity line of credit, okay? But aside from that, most people understand loans, or as far as mortgages, those loans, they have to get into those tools. But what they don't know is how they can change and pay that mortgage a little bit differently, right? And that's what we teach. So here, let's go over quickly the loan versus the line, and then we're going to go get into, what this gentleman's, conundrum was, okay? So when we have a loan versus a line, okay, so we're going to kind of go through some checkpoints right here, okay? So here's your loan, here's your line. Both of them, right, you make payments. You make payments on both of them, correct? Yeah, we make payments on both of them. So, right, we can check both of these boxes because here, that animal looks the same, right, in this case. Now, one, such as the loan, usually has a lower interest rate, okay? So a loan has a lower interest rate and a line of credit has a higher interest rate. And the line of credit has a higher interest rate because it is revolving. And so that is part of the reason why it has a higher interest rate. So we can't check these boxes, right? Because they're totally different, right? One is lower interest, the other tends to be higher interest. So we can't make the comparison there. Now, the loan is on what's called an amortized schedule. Now, an amortized schedule, for those of you that don't know, is a schedule where you pay a set amount, right? The same payment amount every month, but the interest and the amount going to your balance varies, okay? But to give you a set amount that you're going to pay back, it is constant and it's not changing. So that amount you owe is never changing. What changes is something inside of that loan, okay, which is your interest and the amount going towards principal. So with an amortized loan, the banks will set the schedule so that they get their interest up front and in the beginning, while you're paying less in your towards your balance. Okay, you're paying more towards interest, less to your balance in the very beginning of that loan, and towards the end, what you pay for your towards the balance increases, and what you pay in interest at that point decreases. Okay, so it's really set up in the bank's favor, because if you come in and you have a windfall or whatever, and you go to pay it off, right? They still get something for it. They get the majority of their interest, and they're getting it up front. Okay, so that's an amortized schedule. Now we know our mortgages. Our mortgages are on an amortized schedule, just like that. Okay, so you're paying a lot more in interest when you have a mortgage than you are in principal. All right. And when I say a lot more, I mean considerably more in interest than you are to principal. And they're set that way in the bank's favor because they know that the majority of Americans will move within the first 7 years. Okay. So they won't have these mortgages typically for that long. Or if they do, they will end up refinancing it either for a lower rate, or, as we all know, right, because they get themselves in some debt and maybe they want to pull out some equity and use that equity to pay down their debts. So a couple years in, like 3 years in, the bank comes knocking on your door, usually through a mailer, and they say, "Hey, great news. You have been so excellent at paying your mortgage and you have built up X amount of equity. We can give you a cash payment for that and probably even lower your payment a certain degree, and then we'll put you back on a 30-year mortgage," right? So all that interest that you have paid in those first 3 years, you just throw it out the window, right? Because that's gone. You've now reset your schedule. All right. So that's kind of how mortgages work. Okay. Now, here we know that lines of credit, such as a credit card, there's a good example right there, credit card. Lines of credit are figured on an average daily balance. All right. So the average daily balance is different than an amortization schedule. So the average daily balance means that your balance from day to day in that statement period, the bank or the credit card issuer is going to look at your balance and they're going to figure your interest on the average of that. Okay, so it's very different. So that means that your payment is going to be different, right? So we can't then check those boxes either, can we? Because they're totally different, right? Totally different. So then we go and we look at your interest. Okay, so we know that with a loan, your interest and your balance, okay, there is an inverse relationship. Your interest rate you're paying more in interest than you are in a loan than you are at the end of that loan. Okay, and you're paying less in your balance than you are at the end. You're paying more towards your balance at the end, and you're paying less towards your balance in the beginning. And the interest rate is inverse, right? Okay, and we know that with the line, both your balance and your interest are decreasing. Okay, so as you pay it down, unless you were to revolve it like you can, and then put more on it. So usually as you make your payments, you're paying that down, both interest and principal at the same time. All right, now with a loan, we know that there is a set payment amount. Okay, there's a set payment. There's no surprises. You know what you're going to pay every single month for that loan for X amount of years. Okay, and so with a line of credit, that payment amount varies, and it varies because of the average daily balance and the fact that you're paying your interest and your principal at the same time to pay it down. All right. Now, again, it can vary because if you revolve it, meaning that you take more out, then you're obviously your payment and your interest is going to then go up at that point, right? So that's variable. Now, we know that a loan is also closed-ended and a line is open-ended. So closed-end means you go to make your payment to your mortgage and you can't then go get that payment back, right? Once you make the payment, it's all set, it's done. You can't go and retract it and get that payment back. It's gone, right? With a line of credit, you can make your payment and turn around and charge more if it's a credit card, or you can pull money out if it's a line of credit. So you can make your payment and then turn around and pull it back out. So they call that open-ended, okay? And so I did a video a few days ago where I used a jar, a jar with a lid, where you can reach in and pull money out anytime you want from that jar. But with the loan, you absolutely cannot, right? Okay. So there's a little bit more flexibility with the lines of credit versus the loans, okay? But people like the fact that a loan, it's set. They know exactly what they're going to pay. There's no surprises. Okay. So they might like that. Now, what makes these very different, again, are how they're structured, but what makes them very much the same is how you bank. Okay. So if you're banking traditionally and you've been running your finances as we are taught to do, then you're going to run the loan and the line probably the same way. Okay. You're going to make your payments every month and you're really not going to think about how that might be affecting your bottom line. But with velocity banking, which is what we teach on this channel, that comes forefront, right? That is forefront in our mind. And so we do things a little different here. So we X out loans, right? We don't do loans and we always do lines because we have more control when we do banking using lines of credit, okay? And I mean all of our banking through lines of credit. I mean, you're not using your checking account for hardly anything. That sucker's sitting at zero for the most part, okay? So the gentleman that I ran into, actually Dan and I ran into when we were at the bank, we had this conversation with him and he wanted to know, he said, well, I don't understand. Like, can you, explain to me? So I take, a deposit ticket and I flip it over and I just give him a hypothetical. I'm like, okay, well, let's say you have X amount of dollars and here's your loan and this is what you have. And I said, you can't then go and get any money. And he said, no, you're right. I can't. And he said, and actually, he goes, I thought I should probably have taken out more money than I did because I've needed extra funds and I don't have them for the business. And I said, aha, that's where a line of credit might have served you better. And he said, yeah, it might have. He goes, but I would have been paying more in interest. So, of course, here I go, the teacher that I am, right? And I take my piece of paper and I start writing down an example. So let's go and take a look at what that example looked like, okay? So here I'm saying that my loan has a lower interest rate, therefore it is a better choice for me, right? So that's this guy's mentality. He's like, oh, it's a better choice. I get a better interest rate. Or is it, right? So here we have a $35,000 loan, okay? And it's at a 9.375%, all right? It is for 48 months, and the total interest that this person is going to pay back is $7,106 in interest, okay? And the payment on that, it's a pretty hefty payment. It's $877 a month, okay? So that's a pretty good payment. Now, this is a loan, so it's on an amortized schedule, okay? So if we take a look at this and you kind of deep dive into it, I've got the balance here, the interest, the principal, and the ending balance, okay? And this is monthly. So this is done in months, obviously, because it's only a 4-year loan, right? So it's done in months. And this gives us 1 year of that loan on an amortized schedule, okay? So if we start with $3,500, we know that after 12 months, we're going to end at, $28,093. That's going to be where our balance is at the end of 12 months, okay? The end balance is actually going to be 27,435. It starts this month at 28 and ends at 27,435. All right. So we let it run down for 12 months and we have paid $2,962, so almost $3,000 in interest payments. And our principal, we've paid down by $7,567. Okay. Interest, again, you can see how the interest is dropping, right? The interest is dropping. As we can see, our balance then is increasing, okay? As we go along, the balance is increasing, and as we go along, our interest is actually dropping. So there's our inverse relationship, okay? So this is what I love about velocity banking and running this channel, right? So what's funny is after going through the scenario, he wanted to know more. So I did give him the channel and I said, if you have any questions, I said, you can certainly email us, but just go learn it. He was really interested, right? So he was interested because of this example. So here we go with an example of how we would run this if it was velocity banking, okay? So we used an income, and it's about his income. It was $5,800. And the total expenses that he has are $5,200, okay? And so we're just taking, straight numbers here. So we know our cash flow is $600 a month is the cash flow that this individual has, right? So I showed him, I said, okay, so let's say you did this as a line of credit instead, okay? And you already said that you wanted to be able to take more money out because there were some things that you would have liked to purchase with that, right? So he already said that. And I said, okay, so let's see if this could work for you. Let's see what the difference is. So we start and we say, okay, so this is going to be, I just gave a number. I said, let's say it's 12%, which is obviously higher than 9%. I said, let's say it's at 12%. Okay. And I said, so let's say you got a personal line of credit here and you did it for 35,000, personal line, home equity line, whatever. Okay. Business line, doesn't matter. So 35,000. And I said, and you put all of your income in, because remember, when we do velocity banking, we are going to take every penny of our direct deposit or our income, and we're going to put it on that loan so that we can drop that balance, right? Because these are done on an average daily balance. So we want to drop that balance as quickly as we can so that it's less interest in that month that we pay, all right? And so because this is a line, we don't have to hold anything out for mortgages. We don't have to hold anything out for cars, any other credit card payments, none of that, okay? Again, this is a line. So we put in our $5,800, right? Okay. And then we have to, we're going to be subtracting our payment, our $877 from our expenses, right? Because that is no longer an expense when we do velocity banking. Because when you put your income into that line of credit, it is satisfying that payment that would be owed, okay? And many times payments are not just interest only. Some of them are, they can be if you have it set up that way, but a lot of times it's about 1% plus the interest, okay? So 1% plus the interest is typically what you would pay. So this payment then comes back to us through expenses because we don't then have to include it in our expenses anymore as we were here, okay? So this comes back to us. So now our expenses are $43.23, and I explained this to him. So I said, okay, so what we do is we take our high balance, we take our low balance, and then we average them. We add them together and we divide by 2 to get an average, okay? Again, average daily balance. So we get our average, and then we're going to multiply that average by 0.12, right? So 0.12 to put it into a decimal. So we're going to multiply it by 0.12. That gives us a year's worth of interest. But we don't want the year. We just want the 1 month because we know every month this is going to drop. So we get our 1 month of interest, and here we showed that it's $321. And I said, okay, so now we know that we are going to be spending everything through this line of credit. Okay, all of our expenses we're going to be running through that line of credit. And again, when I talk about it being a line of credit, if it's connected to your checking account, which is usually how that works, okay, you can use it as overdraft protection. If you can't, then you just manually move the money and then run it out of your checking that way, okay? So had to make that distinction. He had to understand that, so I explained that to him. And so here we then show that we are going to run everything through that line of credit. So all of our expenses, all of the household expenses, all of the groceries, gas, all of it comes out of the line of credit then, okay? So here's our expenses. Now here's our interest, okay? So we got our 1 month interest. So it drops our balance then. In the first month, we're at $33,884, okay? So how long did it take us? Look, this is 1 month and we've dropped it already to $33,884. So then we go in the second month and our income comes back in, right? Our direct deposit goes right back in. So it comes in, it hits the line, and it drops it to $28.44, okay? Look, at 12 months, look at this. We're already here, 12 months. Now, granted, we still have our expenses to run through it, so it's not quite apples to apples yet, right? So we have to run our expenses again, and now we're at month 2, okay? So now we're down to $26,876, but then we have to put our expenses have to come back in, and our interest has to come back in. So now we're back to $31,496, okay? And we keep running it this way, right? So we keep running it this way. And so here we are, month 3, with our balance of $25,696. Again, look at 12 months where we're at, all right? So if we keep running this down, right, what does it look like? What does this look like for our gentleman here? So it looks like this, all right? So it would take 23 months to do this, all right? So it would take 23 months. Now, he did go and meet with the banker, and I finished it out by hand for him to show him, so when he came back, how long it would take, okay? So it took 23 months to run it this way, and the interest paid is $4,233 versus the $7,106 that they would have paid in interest letting it go traditionally, okay? So this is the power of velocity banking, and this is why we say you should run your expenses this way, and you should run everything through a line of credit. Now, if you were to do the traditional banking style and you left your line of credit and you just paid it monthly, it would take you 52 months and it would cost you $9,889. So yes, if you're traditionally banking, he would be right that the line or the loan would be the way to go. But that's not what we teach here. And we know there's a better way to run your finances. More importantly for me, what this did is that it saved him time, right? It would save so much time running it this way, 23 months versus 48 months. Then you can get back to living again. Or, if he needs to make another purchase for his business or whatever, right? He can then do that pretty comfortably because he knows how this works and it works fairly quickly. So I even went as far as, and I didn't go quite this far with him, but I showed him the graph too, right? Where we took the 35,000 and then we showed that when you put your payment in, you put your direct deposit in, how it drops down to 29,200, and it shows the interest, and all of them, right, are dropping down as we go. So this is just a really cool, on the fly example of, velocity banking and how it can work. Teach others, you guys. Show people how to do this because it saves so much money at the end of the day. Hope you guys had a great day today. Hope you learned something. And by all means, we'd love it if you continue to like so that we can get out there and everybody can see more about velocity banking because it changes lives, you guys. Anybody that knows me knows that I'm an ex-banker, ex-branch manager. I understand these tools. But even I didn't know how to run it this way until I learned velocity banking. Have an awesome day, guys. We'll see you next time.